Hello, everyone, and welcome to this special quarterly investment outlook podcast. I'm here with Tom Stevenson, investment director here at Fidelity, and we're going to be answering your questions today. It's something that we do every few months, timed to accompany the latest edition of the Investment Outlook, which is published this week. We're going to be getting through as many of your questions as we can in the next half hour to 45 minutes. Tom, welcome along. You pull together the investment outlook. It is a snapshot of your view of the market, including where you think different asset classes might be headed. I'm going to give some of the details on where people can find the investment outlook a bit later on near the end of the show. But before that, and before we get into the questions, actually, let's get your updated overview at a high level of where investors are right now. We're a little more than halfway through 2025, and it's been a roller coaster of a year. 3 months ago, the last time we recorded one of these things, alarm was very high, concern was high about tariffs being announced in the US. The story's moved on a bit since then. What's the mood in markets now?
Well, we're in a very different place from where we were 3 months ago. As you say, when we were sat here at the end of the first quarter, we just had the announcement of the tariffs. So there was a huge amount of uncertainty in the markets about what that actually meant. And of course, a week later, those tariffs were postponed, or there was a 90-day pause was implemented. So, everything changed. So the market sentiment was pretty negative 3 months ago. Now, roll forward 3 months, and it's almost the, polar opposite. The market is pretty buoyant at the moment. Many markets, including the US market, have hit a new all-time high. Mm-hmm. We had about a 20% fall from the February peak until the bottom of the market just after those tariffs were announced. We've clawed it all back again. So the market is up 25% in 3 months. So it has been, you said roller coaster. That's exactly right. It's been an amazingly volatile market in the first half of the year.
Yeah, and a lot of the questions we got this time reflect some of that. Let's not waste any more time getting into the questions. I'm just going to add here that these are Tom's view of the market. It is not investment advice and should be seen only as guidance. That said, let's get into it, Tom. The first question is this. Is the UK fast becoming a lost cause for international investors? And if so, what can the UK government do about it? So do you agree with the premise of the question, first and foremost?
Well, I think it depends how you look at it. If you're looking at the sort of overall health of the UK stock market, then I would suggest it's not in a great place. The number of companies on the UK market is shrinking. Very few new issues coming to the market. Lots of companies leaving the market, and so the size of the market is diminishing. There's not a huge incentive for companies to list on the London market because valuations are low.
Yeah.
So that's one lens that you can look through. If you actually look through the investment lens, actually things don't look too bad. I mean, the market again, as like the US, the UK market is at or close to an all-time high. The performance of UK funds. I'm thinking specifically about some funds on the Select 50 which focus on the UK have done very well in the last few months. I mentioned companies leaving the market. One of the reasons why companies are leaving the UK stock market is because they're being taken over. There's a lot of interest from overseas buyers, particularly American buyers, private equity buyers. They look at the UK market, they think it's cheap, and they're snapping up companies. And that, of course, is helpful if you're investing in the UK because they tend to go at a premium to the market price. So yeah, I think depending on the lens that you're using to look at the UK market, you could be pretty pessimistic or you could be a bit more optimistic.
And what about the performance from an investor's point of view? Better this year?
Yeah, it's been good, actually. I mean, in terms of the sort of rankings, European shares, so continental European shares are top of the list. They've had a great 6 months, up about 20%. but the UK market is up about 10%, sort of in line with emerging markets, and all of those markets have done better than the US market, despite the fact that the US has recovered to a new all-time high. Actually, since the start of the year, it's only up 5 or 6%. So, yeah, the UK market has performed pretty well.
And the second part of the question was what the government can do about it, if anything. We're going to come on to some of the potential changes it's going to make and some of the justifications for it. It's hard, isn't it, for the UK government, any government, to suddenly say, come and invest in our country. It's a great environment. Businesses will make the decisions on cold, hard facts.
They will. And I think what governments can do is that they can set the framework. So in terms of regulation, for example, or the rules, the listing rules, how onerous they are, how difficult it is for companies to acquire a listing and to maintain a listing. That's one thing that governments can do. I suspect that we'll talk a bit later on about speculation around the cash ISA. So I think the government is keen to encourage people to shift their savings from cash. There's a lot of money sits in cash into stock market investments. That would obviously help because anything which boosted the valuation of the UK stock market would encourage more companies to list. So there are some things they can do.
Yeah, exactly. That conundrum of, companies looking to list in, often they can pick and choose where they're going to list their shares. If you've got a UK market which is consistently on a lower valuation, they're going to think, well, why do that? We want our company trading on a very high valuation.
Yeah.
And the best thing that could happen would for the UK market to have a period of a sort of strong outperformance versus other international markets to remind everybody that, it's still possible that there is a kind of willing audience for your, that will inject capital into your company if you list it.
Yeah, absolutely right. That would be the best thing that could happen. That's not really in the hands of the government. So, the government can talk the market up, and they can create the circumstances in which the market can flourish. But ultimately, it will be what it is.
Okay, next question, Tom. I have about £25,000 to invest, the questioner says. Is it worth doing a stocks and shares ISA or to buy a fixed rate bond at about 4%? I guess that means a savings bond. I'm 80 years old, so not looking for anything long term. So probably answer this relatively quickly, I think.
Yeah. Okay. Well, I mean, I think I think there is merit in both approaches, given the age of the age of the questioner. I think what I would say about the bonds, I don't really know precisely what sort of bond they're talking about. It can cover various different types of investment. I would say look carefully at what restrictions there may be about, for example, withdrawal, because the attraction of a stocks and shares ISA is it's very flexible. You can take money out of a stocks and shares ISA when you want, and particularly at that age, that may be something which is attractive.
Yeah, and I would jump straight on the age point, and they've said themselves they're not looking for anything long term. Well, if you're going to be a purist about it, that means you really shouldn't be investing your money, because you need to be able to let it do what it's going to do in markets, and that might mean falls in the short term. So maybe that pushes them more towards safer assets like cash. I presume they're talking about a fixed term cash rate bond.
Yeah.
And 4% is competitive. It's higher than inflation, just about. So their money will be getting more valuable in real terms. Not a bad place to be at 80.
I think so. I think if you're looking at investing for any period of time less than about 5 years, then I think it becomes a bit marginal whether you should even be thinking about the stock market at all, especially at a time like now when you can earn a decent return on a cash investment. If you can get 4 or 5% in cash with really almost no risk to your capital, then at the age of 80, that doesn't sound too bad.
Okay, let's move on then, Tom. The next question is this. With equities back at their all-time highs, despite material shifts in geopolitics, US trade policy, and with fiscal worries having adverse effects on fixed income, how best would you navigate a balanced portfolio, including choices between active versus passive? A lot there, I can see in this question. Yes. But basically, where do you find your balance? Where do you find your diversity, your diversification when markets are as they are?
Yeah, I mean, again, I think this is quite a simple question to answer. I think that you want to find diversification both within your equity holdings, your shares, and you can do that on a geographical basis. Many different markets are trading on different valuations. They have different prospects. It's very difficult to predict. I mean, at the beginning of the year, it would have been very hard to predict, for example, that Europe would have been top of the table with a 20% gain. So I think having a good geographical diversification with your shares obviously makes sense. But then also in terms of asset class, spreading your eggs around different baskets. So some bonds, maybe. I think bonds, it's a difficult time for bonds at the moment because bond yields are rising, even despite the fact that interest rates are looking to come down. Investors in bonds are demanding a higher income to compensate them for some fairly significant risks around inflation, around policy uncertainty. So I'm slightly hesitant about bonds. But if you look back over the chart of the last 6 months, actually, government bonds have delivered what they're supposed to deliver. They've delivered a relatively smooth ride, a positive return, and inflation matching return. So, I do think they have a role in a diversified portfolio. The other asset, which of course has done very well in the last 6 months, has been gold. Gold is a great diversifier. It moves differently to bonds and shares. And there are other things that you can look into. So, for example, infrastructure investments. We have talked about infrastructure fund on the Select 50 that we particularly like. Property. There are various different ways to diversify in terms of asset classes.
Okay. Well, let's move on for now, Tom. This next question is really interesting, actually. Relates to some work that we've done recently at Fidelity. The question is, would a 77-year-old be advised to swap their flexible drawdown SIPP into an annuity now, or wait for markets to rise even further before doing so? I'm going to reiterate our warning about not giving financial advice. So what we say is not directly relevant, but it's such an interesting question. 77 years old, they've been in drawdown, they're thinking about an annuity. It's an interesting time to be in that position.
Well, there are lots of questions to ask before you make that move. I mean, the considerations that you're thinking about is, what is the probability of the market continuing to rise, which is part of the question. That's a challenging question to ask. The market is trading at an all-time high, so. That's one thing to consider. The other thing to consider is the age of the questioner. 77. At 77, you're going to get a pretty high annuity rate because you're relatively old. So from looking at it from the other side of the equation, if you're the insurance company offering there's a fairly good chance that you're not going to be paying this out for huge number of years. So the older you get, the better annuity rate you will be able to find. I don't know. What do you think?
Well, I thought it was a really interesting question for all sorts of reasons. I mentioned we did this work earlier this year, looking at exactly this type of issue. We looked back at the 10 years of pension freedoms. That's the period in which drawdown has been opened up to lots of people, and we looked at how markets had performed in that time and what would have happened to pension pots had people been withdrawing their money over the past 10 years. I don't know exactly this person's circumstances. They say they're 77. They're in drawdown, clearly. So it's fair to assume they've been invested in that in the past 10 years, and they will have done very well. This is what our work showed. So despite the pandemic, despite an inflation crisis, the war in Ukraine, all these things that knocked markets in the short term, they've climbed and climbed and climbed. And lots of people actually, even if had they been withdrawing money, as long as they were withdrawing kind of sensible amounts, they'd probably have more money now after 10 years than they started with. And I suspect if this person's got any kind of conventional portfolio, they'll be in that position. So it's a great position to be in. They've been withdrawing money. They've had a nice market that's been rising and helping them, and now they get to pick an annuity. Annuity rates are great at the moment because long-term gilt yields are high. And as you say, they're going to get a better rate anyway because they're that much older. And they've got fewer years to pay for. I mean, 77 years old. I mean, you'll be doing well to get another 20 years of retirement, right? So this is how you want to do it, basically. This is how all the income options that people have now in the UK for their retirement income, this is an example of it working really nicely. 10 years in drawdown, lots of growth. Now pick your moment for an annuity.
Absolutely. And what you've described there is the kind of sort of logical analysis of whether it makes sense. But I think there's also a psychological aspect to this that, at the age of 77, I think that your appetite for managing a portfolio in the markets, keeping an eye on what's going on, it probably diminishes. And, you may well welcome the opportunity to lock in an income for the rest of your life and not have to think about what's happening in the markets. I mean, just from a personal perspective, I think that at the moment I love it. I'm really interested. I want to manage my money. I think in 15 years time I may feel slightly differently,
and it's to do with your lifestyle as well. I mean, people, it's not a surprise to hear, people slow down when they get closer to 80 years old. And so they probably have a little bit more certainty about what actually they're going to be spending. It's, you don't have to kind of constantly be thinking about your finances in terms of what markets are going to be doing. If it's a good year, I can do this. And if it's not, I won't. That certainty's what a lot of people want, particularly in the kind of second half of their retirement.
Yeah, absolutely.
Okay, well, let's move on for now, Tom. Okay, this question is about a specific fund that I think you know well, Tom. The Brown US Small Companies Fund has performed very badly since January 2025. Is it a good idea to sell this fund, which we are still holding with a year-to-date loss of approximately 12%? Should I reinvest the proceeds elsewhere? So tell us about that fund and why it's moved and performed in the way it has.
So the Brown Advisory US Smaller Companies Fund is actually one of my recommendations for the year. So I share the pain of this reader. It's not been a great recommendation. It has fallen in value. I think I was not the only person at the beginning of the year to think that a Trump presidency would be, relatively good for the US and less good for the rest of the world. That was the prevailing narrative at the start of the year.
So that gives you a US pick.
Yeah. And so I thought that it would make sense to have a US pick. At the same time, some of the biggest companies in the US were pretty highly valued. Those Magnificent Seven tech stocks were pretty highly valued. It was felt that a growth-focused Trump presidency would be good for more domestic, smaller companies. So the logic was sound. It just hasn't turned out that way. I think the way tariffs have unfolded, I think that there's been a growing realization that tariffs are probably potentially damaging for growth and inflation within the domestic American market. And so appetite for smaller American companies has not been good. Having said that, the question is, should I stick with this fund or not? My instinct, and again, this is not advice, this is, the way I look at it, is that, I think that fundamentally it's a well-managed fund. I think in the long run, smaller domestic American companies are going to be a good place to invest over the long haul. And I would be happy to hold this. And the fact that it's fallen 10% in the short term is not great, but it's not the end of the world. So
6 months is too short.
It's far too short a time to be judging performance.
Yeah, and just a word on the state of the US economy. Right now, as we speak, lots of positivity around the market. Well, a sort of qualified positivity. People are investing for sure, and markets are high. Probably lots of reasons that people are worried. But But what's the economic news underneath all of that? Because that's ultimately what's gonna shape what stock markets do.
Yeah, I mean, I think there are a couple of important developments in the first half of the year. One has been the tariffs that we've mentioned, and that process is unfolding. As we speak, there's a huge amount of uncertainty about how that will impact the economy. The second important development has been the passing of this so-called one big beautiful bill. Which is basically a tax.
Ludicrous name
it's a ludicrous name, but it's basically a tax bill. Quite controversial. I mean, arguably, it involves a significant transfer of wealth from the poorest Americans to the wealthiest Americans. So, make of that what you will. But the significance of it in market terms is that it suggests that US government borrowings are going to rise very substantially in years to come. So that is creating a bit of uncertainty about appetite, especially for overseas investors, for American assets and the dollar. But the positive of this, basically this tax cut for wealthy Americans, the positive is that in the short term it may generate some growth in the economy. So I think that there's quite a two-way pull going on at the moment in the US economy. I think the expectation is that we will see a slowdown in the economy because of the tariffs. There's a short term, a bit of a sugar rush from the tax base, and then longer term, I think there are some concerns about the sustainability of American public finances. So, that's a long, convoluted answer to a question which basically concludes that there's a lot going on in the US at the moment, good and bad.
Okay. The next question, Tom, is an interesting one and actually reflected a few, on a similar theme. I'll ask the question. When Trump introduced his tariffs, I sold all my stocks and I'm now sitting on cash. I'd like to be investing, but I'm concerned about a possible crash. What signs would indicate that it might be a good time to get back into the market?
An interesting question.
Yeah, I think lots of people are in a similar position. And we're the safe space of the podcast. There's no judgments about people making these kind of moves. I think lots of people did make similar decisions this year, at the start of this year. I think the circumstances were such that they almost were extra encouraging of people to try and basically sell out of the market and sit things out. And lots of people now are second guessing that decision. What advice would you have for them?
Well, I mean, I totally understand why 3 months ago, with the announcement of the tariffs, someone would have been very nervous about the market and would look askance at the US market. Of course, what history has hindsight has shown us is that that was a great time to be actually buying the market. Yeah, and that is so often the way that when the outlook looks most worrying. And the market has fallen to reflect that worrying outlook. It doesn't take too much good news or even less bad news for the market to recover, and that's exactly what we have seen. So the second part of the question, I think, was around what are the signals that it's a good time to get back in, and the rather unhelpful answer is there aren't any.
You don't get signals.
You don't get signals. As they say, no one rings a bell at the bottom of the market or the top of the market. And it's a very, good reminder that trying to time the market is fraught with danger. And the best thing to do really is to stick with it, to take a long-term view, to look at your investment horizon and not worry too much about what's going on in the short term. Easier to say than to do.
And very forgivable that people did sell out, because I think it wasn't just the tariffs. That's part of it. It's the fact that we just had 2 great years in markets. So people are sat on, they're kind of like, well, maybe now you take my winnings, take money off the table. that's how they start the year. They know that there's this big concentration of risk inside these small number of very large companies that have done very well. All sorts of reasons why can you remember DeepSeek? Everyone was worried about DeepSeek, this sort of Chinese AI, and that was going to knock the Magnificent Seven. So there are all sorts of kind of reinforcing narratives to say, yeah, sell, just sell. The tariffs come along, trailed beforehand. Yes, that seemed to encourage people to sell, and then they did, and then they were reinforcing that decision because markets fell, and then they've come roaring back. And this is the problem. You just don't, before you know it, it's turned out to be the wrong decision.
Yeah, and I've just written a piece actually, interestingly, this week on this. There's this old adage about stock markets that they're both in the short term they're a voting machine, which essentially they respond to changes in sentiment, and the mood of investors. In the long run, stock markets are a weighing machine, so they essentially assess and respond to the change in fundamentals, the profits, the earnings growth. And, both of those things can happen at the same time. And the reason I was writing about it was because I think the next month is going to really test that balance between the two. Because on the one hand, we've got the earnings season is just about to start. And that's the sort of weighing machine aspect of the market. But at the same time, we've got all this uncertainty around tariffs. The president has just kicked the can down the road. From the 9th of July was a hard deadline for tariff negotiations. That's been kicked down to August the 1st. That's right in the middle of earnings season. So there's this tension between the weighing machine aspect and the voting machine aspect.
Yeah, and just finally, before we move on, when you make decisions around your investments, actually, if you find you're making it based on what you think's about to happen next in markets, stop and think, because those decisions really should be made based on, should I be exposed to the risks of the market when my other financial circumstances are XYZ? You need to be kind of agnostic about what's going to happen in markets, because you don't know what's going to happen in markets.
Yeah.
So you just have to say, well, am I willing to be exposed to the risk of this? And if this person is like, well, I'd like to be investing, that was probably true when they sold out, that they would like to be investing. They just didn't want to suffer any short-term falls.
Yes.
And I don't want to be judgy about it, because I've done similar things in the past, absolutely. But it's another example of markets having recovered in the short term.
It's the difference between volatility and risk. The risk is that you lose money permanently. You crystallize a loss and you never get back into the market to regain it. Volatility is the natural ups and downs of the market, and that is the price we pay for the long-term outperformance of shares. And again, I'm not judging either, but I think if we are investors, we are investing for the long term, and we have to accept the volatility. We have to accept that there will be moments when our portfolio is worth 10, 15% less than it was.
Yeah.
And we have to learn to get relaxed about that.
Yeah, indeed. Okay, let's move on, Tom. The next question is this. I am wondering how safe cash-like funds and money market funds are. So, for example, the Fidelity Cash Fund, the Legal and General Cash Trust, the Royal London Short-Term Money Market Fund. How do cash-like funds react to a big stock market crash? Do they remain unaffected, or do they crash too? And if they are unaffected, what would cause a significant devaluation of these types of funds? So what are the funds we're talking about here?
Yeah, so these funds that you mentioned, the cash funds like the Fidelity Cash Fund and the Legal and General one and the Royal London Cash Fund, they're pretty safe. They're not as safe as cash. They do invest in short-term bond instruments, so they're cash-like rather than cash, but they are as close to cash as you can get without being in cash. Ultimately what determines the returns that you get from them is interest rates. And so if there were a big stock market crash, then you might expect interest rates would probably probably fall in response to that, and the income that you would earn on your cash fund would fall. There's always a bit of a lag before that happens. But in terms of the return of your capital, then it's not guaranteed, but you are likely to get
close to
cash. You're likely to get your capital back.
Yeah, and just to explain that a bit more, so they're buying bonds often, but the bonds are maturing in very short periods of time.
Yeah.
So the things that would normally move a bond's price, like inflation expectations and growth and things like that, there isn't the opportunity to affect the bond's price in that short term, because if you're going to get paid your £100 back in 2 months or something, you're going to get it, and inflation's not going to really.
It's not an issue.
It's not going to be an issue. If you look at the performance of these funds, they basically always produce a positive return in absolute terms.
Yeah,
it is actually possible, because they charge a fee to invest. If interest rates are super, super, super low, and there was a period, of course, when they were 0.1% was the bank rate for a while, they can actually produce a slightly negative total return because of the fee you're paying. But in generally, they're not going to do that. And you look at the charts of these things, and they basically move up to a greater or lesser degree,
and they also move up in a very straight line.
So
it's a very smooth ride. And at the moment, when interest rates are relatively high, the last time I looked, the cash funds that we're talking about were paying a yield of about 4.5%.
Yeah,
which is
dipping a bit actually. I was checking today, but not crashing or anything, but just a gentle dip in line with what interest rates are doing. Of course, what the performance charts won't show you is a real return. So like cash, these can be affected by inflation. Like any investment, they can be affected by inflation. And so if inflation is higher than the returns you're getting, then they are going to produce a real terms loss of value. But no, they don't crash, basically, to cut to the chase of this question. They don't crash with stock market investments, not least because they're not actually stock market investments, are they? They're bond market investments.
Yeah, that's exactly right. So, I mean, for someone who is looking, for a relatively safe haven within a stocks and shares ISA, for example, then a cash fund can be very attractive for that reason.
Speaking of ISAs, Tom, the next question is a very interesting one, very topical one. It is this: what impact might the Mansion House Agreement and possible reduction of cash ISA allowances have on the FTSE All Share? So just unpack some of that, Tom, because it takes some explanation. Mansion House, cash ISAs, what's going on there?
Yes, so we mentioned this at the beginning, that the government is keen to divert some of the savings which are currently sitting in cash ISAs into more productive stocks and shares ISAs. There's about £300 billion sitting in cash ISAs out of a total of about £700 billion sitting in ISAs. So nearly half of it is in cash. And the Chancellor is I mean she's dressing this up as, I want people to get a better return, and that's a noble aim, and it's one that I would agree with, that over the long haul stock markets have performed better than cash, and so tying up your money for long periods of time in cash may not be the best thing to do with your money. The other side to what the Chancellor is trying to do, though, is she's trying to stimulate investment in UK listed companies, partly to sort of boost the attraction of the UK stock market, but also to boost the growth and the productivity of the UK economy as well. So there are quite a few things going on at the moment. Anyway, cut to the chase. What she's expected to announce next week, on the 15th of July at the Mansion House speech, this is the Mansion House element, is a reduction in the contribution limit for cash ISAs. So at the moment, you can put £20,000 into an ISA, and you can put that in stocks and shares or in cash. The choice is yours.
In any mix you want.
The speculation is that the amount that you can put into cash is going to reduce. It may reduce to 10,000 or 5,000. No one knows as we speak. So what impact would that have on the stock market? Well, it may have a positive impact on the stock market were that money to be redirected into stock market investments. I slightly have my doubts about whether that would be the case, because I think if you like cash and you want the security and safety of cash, you're probably going to leave your money in cash. All that's going to happen is, to the extent that you can't shelter it in an ISA, you're going to put it in a taxable cash account. So it may have less of an impact on the stock market than maybe the intention is.
Yeah. And that's if any of this happens. I've been around long enough, Tom. You see these rumored changes, and it's the big changes you never see coming. And I don't know. This has been trailed. It feels like there's something to this, and you see these reports. Officials are saying this, and leaving open the opportunity for this. So maybe something happens, but it's an interesting one. There's lots of opposition to changes to any
very
reduction.
Unpopular.
Yeah, and led by building societies, because they of course provide cash ISAs. There's an alternative case that's being pushed forward by investment companies that they offer stocks and shares ISAs. So there's always a bit of special bleeding going on. I think that if there's a reduction in what you can put into cash ISAs, and the government is serious in what it says about these aims about stimulating the stock market, probably they're going to have to be a whole load of other stipulations that come along with that reduction in the cash ISA allowance. You would then have to be told, well, what can you put in your stocks and shares ISA that's going to fulfill this aim that the government has? Does that mean British company shares? Does it just mean companies listed in the UK? We've spoken about cash funds. You could hold those inside a stocks and shares ISA. So that's how you get your cash-like return. Is the government bothered by that? Will it close down that route? It's a bit of a Pandora's box, actually, when you go down this route.
It is.
And it may, like I say, it may well happen, but I think it's a bit more complicated than at first sight.
I totally agree, and I think that the problem with this whole debate is that, as you alluded to there, most of the people who've got something to say about this have basically got a dog in the race.
Yeah, sure,
and,
absolutely.
So you have to take what people say slightly with a pinch of salt.
Yeah, and look, I think government policy works best when it's very simple, and I think that, what the ISA, all the savings regime in general, but the ISA regime in particular, there's an advantage to the government. There's a benefit to the government for people having to save money for their future. They're less likely to rely on the state. It also makes them more capable of making productive choices in their life. I'm gonna retrain because I've got some savings that allow me to do that, and I'm going to get a better job in the future, or I'm going to get promoted. I'm going to take a risk on a job move. All these things that savings enable you to do, and financial security enables you to do. That's a good thing for the country. That's one incentive, and then to sort of tack on this other aim of like stimulating, UK PLC as a destination for foreign investment. It risks muddying the waters, really.
Yeah, I agree with that. I wrote about this in a recent Telegraph column, actually, and the point that my conclusion was, actually, it doesn't really matter whether people are saving in cash or shares. We shouldn't be bickering about that. What's more important is that we educate people as to investment risk, so that they understand what they're getting with cash, what they're getting with stocks and shares, and when those are appropriate for their needs, and how much of each that they need. That's what we should be focusing on. Yeah,
and just finally, before we move on, because we've still got questions to go through and we're sort of pushed for time, but this £20,000 that you're allowed in cash, that's a large amount of money. That's £20,000 every single year that you could shield away from any tax. People who are using all of that and using all of it in cash, like, some people just won't want to invest their money, but I think there'll be a strong case for if people can really afford to do that and put those kind of savings aside, then actually they probably can afford to take the risk with investments. You know what I mean? I don't think it's a mad idea. I just think it's difficult to implement.
I totally agree.
Okay, let's move on, Tom. Hello, I am now 59 years old, the questioner says. My SIPP is valued at £340,000. I'm self-employed, so I have some flexibility over my retirement plans, but would perhaps aim to retire at age 64 or 65. My question is, should I consider drawing some of my 25% tax-free allowance and ring fence it in my ISA to avoid the risk of any changes to tax in the future. So basically, should they take tax-free cash that they could get now and just put it into ISAs? There's a second part of the question that says, if I did increase my ISA savings, would that have any implications if I was assessed to help pay for any care costs for my aging mother? So there's lots going on in this question.
Well, let's deal with that last bit first, because I think that's relatively simple. That my understanding of this is that the mother's assets will be assessed when it comes to determining, whether how much she needs to contribute towards her care and how much the state will contribute. I mean, basically, you need to run out of assets before the state will step in. That's the sad reality of it. I don't think the son's assets are a factor when it comes to this.
One possible exception is, it's been a long time since I really got under the bonnet of this care stuff, but I don't think they look favourably on sort of big gifts of money from parents to children. So
exactly right.
That might be a different case, right? If suddenly,
I mean, if clearly you are giving money away in order to avoid having to spend it on care, then that is taken into consideration.
Yeah. So there's that part.
Okay. So that's that part of the question. The first part of the question then was about tax-free cash. So I defer to you on this actually, Ed, because you this is more your area of expertise. But I mean, there is a case for doing just that in certain circumstances. You've had the benefit of the tax relief on the way into your pension.
Yeah.
There is uncertainty about what government policy will be regarding tax-free cash. So there is a sort of bird in the hand argument here. But you've got to do something with that cash. There are rules about recycling money into pensions, which you need to be aware of before you do that.
Yeah. But
that's probably all I've got to say. I don't know what you can add to that.
Not so long ago, this would have been a bit more simple to answer. The received wisdom is always that, if you haven't got a specific use for your tax-free cash, don't take it out. And in fact, people taking it out and putting it into savings, albeit ISA savings in this case, was sort of frowned upon. It's like, why are you doing that? In point of fact, the tax treatment of money inside an ISA is the same as the tax treatment of money held inside a pension. The withdrawals from a pension are taxed, but not the tax-free cash part. But so it might be fine to hold it in an ISA. You're going to get tax-free growth. Pensions under the current system are advantaged in terms of inheritance tax. Yeah. That's an advantage.
Although that's changing.
That might be changing.
Yeah.
So basically, to answer this question properly for this person, you need to know whether they're going to plan to pass money on, whether they think they're going to have an IHT liability at all. There is a way in which it's sensible to do what they're saying, or that there's no cost to doing what they're saying. But it does reduce their flexibility, I think, to take all of that tax-free cash. They might want to take it in a different way in the future, in a way that they don't foresee now. But it might be that they want to use it differently in the future, and they won't be able to do that if they've already taken it. It's a great point for pushing advice here, isn't it? And saying, actually, an advisor will tell you way better than we can, and will look at your circumstances and tell you what's at stake in a decision like that.
Yeah, I mean, that was the point. The final point that I was going to make on this is that actually this is a really good example of a case where advice makes sense.
Okay. Okay, the penultimate question, Tom. Warren Buffett, it says, has been right about many big money market calls. Think the dot-com bubble and the global financial crisis. Currently, he is holding a record high amount of cash in Berkshire Hathaway and has sold an awful lot of stock for tips. That those are inflation-linked sort of
bonds.
Yeah, yep. US bonds. As someone who is recently retired and who has a lot of cash in money market funds, would you bet against Buffett and invest these at all-time highs? or would you wait it out? So would you follow Warren Buffett and hold lots of cash?
Well, look, the way I would answer this question is, I think the key phrase in here is "I'm recently retired." So this suggests that this person, is maybe in their early 60s. So they are looking at, maybe 20, 25 years ahead of them in retirement. Good for them, fortunate to be in that situation. So I would throw it back 25 years and say, if you'd been in this situation 25 years ago, when the stock market was also, at an all-time high before the dot-com bubble burst, so think, what would have made sense to do then? And actually, withdrawing from the stock market at that point, in the short term, would have looked clever.
Yeah.
But over a 25-year period, it would not have looked so clever. So I think that it's very easy to focus on the here and now, to look at the level of the stock market now, to worry about it, to withdraw into cash. But actually, if you are recently retired, you are probably 25 years away from the end of your life. That's a long time for the stock market to work in your favor. So I would think very carefully about that.
Yeah, and you'd have to be quite in a fortunate position and wealthy enough not to invest or not to need to invest your money, because money market funds, cash in general, it's going to produce, the long term truth about cash is it produces a return which is a little bit above inflation, but not much above it. And there's long periods where it lags inflation. You're not going to get much better than inflation. Now, if you want to take your 4% a year and you want to uprate that with inflation, that's the sort of basis often for people's withdrawal plans. Money market funds aren't going to do it, probably. So that might be fine if you don't need that growth.
Depends how much money you've got.
Yeah, it depends how much you've got and how much you want to live off. But if you don't need then fine, But lots of people will actually need some stock market growth, and they're just going to have to take the risk. Doesn't mean they need to go crazy, but I don't judge your kind of entry point on what you think markets are going to do next, because you don't know that.
Exactly right. I'd agree with that.
Okay, final question, Tom. It's been a marathon, so we got there. We started with the UK. Let's end there as well. It says this: Hi, Tom. After the first year of this Labour government, with both large tax increases and ever more borrowing to fund the public sector, will the bond market call time on the UK government borrowing money? What effect would this have on our portfolios? So we've touched on bits of this. What does the bond market have to say about government borrowing in the UK specifically?
Well, this is not just a UK question. I mean, this applies in many developed markets. Governments are much more heavily borrowed than they were before the pandemic, and indeed before the financial crisis. And I think that bond markets are increasingly concerned about the sustainability of public finances in developed countries. But when the question says, will the bond market call time on? Well, I think that's a pretty extreme position. What is likely is that the bond investors are going to demand more compensation for the risks of inflation, of the increased risk, albeit a very small risk, that governments will not repay their debts. Ultimately, a country like the UK, which prints its own currency, is always going to be able to pay back the nominal value of your bonds. You are going to get your money back. Now, but it may be eroded by inflation, and you may feel that you want to have a higher return to compensate you for that erosion of its value. But ultimately, the bond market is not going to call time, in as much as it's not going to, you are going to get your money back.
It's going to demand a higher return. That's what happens. It's happened a couple of times in the last few years. The mini budget 2022. It happens in sort of moments in the past year or so as well. And I'm just interested in that sort of the mentality, if you can call it the mentality of the bond market, because as you say, it's going to get its money back. It's not actually worried about that. But presumably what it's communicating when yields rise and when investors demand a higher return, it's saying to governments, we're not going to buy your debt at that level. We think you're going to have to issue it at a higher level in the future. So we're not going to buy them. We're going to wait for it to rise. And so it has to rise to meet that expectation. Is that what's going on both in the UK and the US, where you see higher bond yields? It's the market saying it's not a default risk we're worried about. It's that this situation is getting worse. You're going to have to borrow money, and we think it'll be on better terms in the future.
You're going to have to pay more to do that because our trust in the issuer of the bonds is diminished. It's less than it was.
Yeah.
This is what they call the bond vigilantes. This is one role of the bond market, is actually to act as a check and balance on governments and to prevent them just splurging and issuing lots of bonds and borrowing lots of money in order to fund their saving. It's a way of keeping them acting within parameters, within guidelines.
And so, what effect would any of this have on portfolios? If we look at a sort of more kind of reasonable scenario of kind of continued pressure on government finances and borrowing, potentially higher yields for a while longer, what does that mean for portfolios?
Well, what it means is that if you hold bonds and the yields rise, then the value of those bonds is going to diminish. But in time, at some point, the return that you're able to get, the income that you're able to earn from your bonds, makes them more attractive. It makes them relatively attractive compared to shares. So it might have an impact on the stock market. But ultimately, it's self-regulating. Once the yield gets to a certain level, people will be attracted by that level and they will invest.
Okay, well, Tom, thank you. That is all the time we have now for questions. A full copy of Tom's Investment Outlook is available to download at fidelity.co.uk/outlook. Thank you so much for watching. And Tom, thank you for joining me to answer all those questions. Thanks.